Welcome everybody to another Red into Black. Today we're talking about trade credit insurance, and it's a really interesting area at the moment, given the current state of what's going on in the economy. We're going to take questions at the end for the guys. You'll find that there is a chat function at the bottom of your screen. Please feel free to use that as we go through, but we'll keep all the questions to the end. So today we've got Paul Danieli, who is a director of Presidium. Now, Presidium is actually a trade credit insurance brokerage, and we're actually really grateful for you to come today, Paul, to actually share a bit of your knowledge in relation to this space, which is really, really specialised. And we've also got Daniel Turk, who is a partner at Turk's Legal. And Daniel's been practicing in this area for a long time. He also practices and is the head of the commercial disputes and transaction team. And he's been dealing with large corporates, SMEs, and insolvency practitioners. I've known Daniel for quite a long time. So welcome, guys, to today's session. And thank you very much for making the time to actually talk to our network. So I'll ask this question to you, Paul. Is it a good time to consider taking out trade credit insurance?
Yeah, thanks for having me as well, Stephen, and PCI. PCI. So, yeah, so good question. Obviously, there's a lot happening at the moment, and really, it really does depend on everyone's risk thresholds at the end of the day. It's funny. When I saw the question come up, I had a bit of a think about it over the weekend, and I recall sort of when the pandemic first hit, the initial thoughts were that, the world was going to come to an end and unemployment was going to go through the roof. And funnily enough, we had a significant spike in demand for insurance at the time, and we had insurance, we had insurers at the same time, obviously being rather pessimistic and not overly keen to write more risk. In that period since then, to be frank, we haven't seen a lot of claims activity in the last couple of years. And really that's been off the back of the government intervention that we've seen predominantly that have propped up a lot of businesses. So right now, though, I think right now we're in a time where there is a hell of a lot of uncertainty, which creates heightened risk from both a general business perspective, but especially from a credit perspective. So whereas during the pandemic, there was a lot of unknown in regards to how this is going to affect the economy, what we're seeing now is a lot more of sort of your traditional economic metrics or matrices that are driving some of the concerns. So, your inflation, your higher interest rates, labour shortages, bottlenecks across the whole supply chain. These are all impacting businesses at the moment. So by way of, is it a good time to get insurance? Based on what we're seeing at the moment, the risk profile has increased significantly. I guess the other thing to be mindful of at the same time is, while insurers back during the COVID times were probably a little more apprehensive and a little bit unsure as to where the market was going, right now we're still seeing a lot of appetite to write risk. So from a timing perspective, we really do have a sort of the perfect storm in the sense that we've got an underwriting market that in most parties pretty open for business. And at the same time, we've got, these economic conditions that are creating a lot of uncertainty. So, yeah, I mean, personally, I think it's always a good time to do it, but right now, especially, I think that sort of the stars have aligned, and it's something that I'd strongly encourage businesses to explore.
So have you, given that, pandemic was probably fairly quiet, as you said, have you actually seen an uptick in inquiry in terms of the product?
Yeah, most definitely. I think what the biggest trigger was coming out of the last sort of COVID wave at the end of last year and early this year. That coupled with a lot more final easing of a lot of the government incentives, we saw sort of an immediate spike in insolvency activity. Most of our claims data is directly aligned with insolvency activity. So naturally that created a whole host of concern. There were some high profile collapses in Q1, which also sort of brought to head a number of these economic issues. So long story short, yeah, we're seeing a significant uplift in inquiry rate over the last sort of 3 to 6 months.
So what are the types of policies what does a typical policy actually look like?
Yeah, okay, yeah. So a couple of things. I mean, your traditional policies, your sort of your whole book approach. So most customers will go down that path. So in effect, you're covering all your debtors, and there's an excess and an indemnity of typically of about 90% applied. So we normally see, I would say, 85 to 90% of all policies are bound in that way. Customers like it that way for several reasons. It's more cost effective. It covers their entire book. Insurers also like it that way in the sense that it does diversify their portfolio as well. So it is what we typically find as the common product. We do also see a number of other products. So there are other clients, for example, larger clients, or even smaller clients, who would prefer to be a little bit more selective on what they want insured. So we'll see where they might have a provision on their balance sheet where they can cover multiple losses up to a certain amount of risk up to a certain level. So we can set up and structure a policy that covers only debtors from a certain dollar point upwards. Conversely, you've got policies that sort of go the other way in the sense of they might have one or two top tier customers that are investment grade and they're very comfortable with them. They may wish to mutually exclude those debtors and then insure the rest of their portfolio. So there's different ways to move it around. From a price perspective, then there's other ways in regards to deductibles, etc., that can also move that premium size. In regards to other products, there's probably one other product that is out there, but it's not typically underwritten these days, and that's more of your single risk approach. So picking one debtor and having it underwritten. We find most of the insurers are very conservative in how they set those guidelines and underwriting them, and from a pricing perspective, it can be quite pricey as well. So to answer your question, I'd say most people look at that whole book approach.
Yeah. So when you're looking at so you generally find that there isn't, people just don't, pick and choose a few debtors. Is there any sort of minimum amount of ledger that you'd look at where this policy is actually?
Yeah, true. I mean, I think it's sort of a two-pronged answer there. I mean, most insurers will have sort of premium thresholds as to where they are willing to write a deal. In regards to minimums, I mean, again, we would normally see on those more selective type policies, typically at least 50% of the ledger would need to be covered still. But again, there's always exceptions to the rule. You've got some that will be at 80%, there'll be some at 20%. So there isn't a hard and fast rule. There is an element of flexibility there that can be applied on a customer per customer basis.
So it's a product that's still well suited to the SME market.
Yeah, I mean, the SME market, we've seen a significant uptake in the policy around that SME space. And by SME, we sort of determine SME as being businesses with revenue less than 10 million. So there is an underwriter being QBE who introduced an SME product during COVID. And that's been really, really successful. Again, up to $10 million, there's a sort of a matrix pricing model set in there. There are some rules and regulations around how it's structured, but it's a pretty good product that covers what you need. And we're finding a lot of smaller businesses are taking it up. Price points are a bit more attractive. We're sort of starting prices at about a $10,000, which might sound like a lot, but in the trade credit space is actually quite low. So becoming a hell of a lot more popular around that SME space, in particular around businesses, that are either seeing growth or starting to take on new projects that may be bigger than what they have traditionally taken on, or or businesses, for example, that might have made an acquisition, or businesses even that have, introduced a new product line or something like that. Something that's sort of taking them out of their risk comfort zone. We find that this insurance really gives them a hell of a lot more of peace of mind.
Yeah. Well, then, talking about then risk, what actually triggers then a claim under the policy?
Yeah, I mean, keeping it blatantly simple is in I'd say right now post COVID, and even pre-COVID, what we find, I'd say 90 to 95% of claims are triggered by an insolvency of the debtor. So be it a receivership, administration, liquidation, So once an OP is appointed, the policy is triggered. So we see that in Australia as being the most common event of a claim. I'd say right now it's probably around 90 to 95% of all claims around that. In effect, the way that works, so triggers a claim. Normally at the moment, we're looking at claims turnaround times of around 4 to 10 business days to pay the claim. That does vary. We've got policy limits depending on which underwriter, where for the claims $30,000, $40,000, we're having them turned around in 24, 48 hours. Conversely, we might have a claim that would be $500,000 to $1 million, and naturally that's going to take a little bit longer. Under the policy, though, the insurers have up to 30 days to assess the claim and come back with acknowledgement of liability or not.
Okay.
Yeah.
And what are there any sort of exclusions from these policies? I mean, are any invoices excluded from them, or uninsurable, or?
Yeah, cool. I'll answer that. There was just one other trigger point on the losses as well before I get to that, if it's all right.
Yeah, absolutely.
The other trigger is what we call protracted default, and what that in a nutshell entails is a client does everything they can to try and recover the money, but the debtor may have absconded. They just cannot get the money out of them. They've exhausted all legal avenues, and they just can't get the money. The insurers have a waiting period, and the waiting period varies case to case. So what we find is that was a lot more of a higher common claim scenario during COVID, and that was because mainly there was some changes to the insolvency laws at the time, which meant that a lot of these businesses were able sort of just to continue to float around. So it still happens these days, but we typically find insolvency is the major trigger point. What was your question again? The next one.
So, what's excluded from what?
Oh, excluded? Yeah, no worries. So, the policy covers goods sold and delivered or services rendered. So, some of the more common exclusions would be it has to be a business-to-business transaction.
Yep.
So it can't cover consumers. It doesn't cover direct business done with a government entity. So that being, say, be it state, federal, or even local level. A really important one is making sure that the policy's description of trade mirrors what they're doing. So, we maybe a bit of a struggle if you lodge a claim if you sold 500,000 hairdryers and on your description of trade you're a wholesaler of steel. So making sure you've got that right. They're the major ones. What else have we got? They're the major ones. I guess the one that triggers on a day-to-day, and especially in the construction sector, that we do see a little bit is disputed invoices. So the insurer will obviously take on responsibility for anything that is undisputed, but should a debtor dispute a particular part of the invoice, it's required that the policyholder would look to settle or resolve that dispute, be it either through legal channels or settlements with the debtor before then that portion of the debt would then be recognised as well. So
yeah, well that's probably a good segue now over to you, Daniel, to talk about the legal aspects of what's actually involved with trade credit insurance. Yeah, maybe can you just take us briefly through, okay, you got this policy in place, you might have an insolvency event, or you might have one of these ones where you might even be disputed, for example. From a lawyer's perspective, what are the steps now that the insured has to actually take?
Yeah, thanks for having us, Stephen, and g'day, Paul. I suppose the other major exclusionary one, Paul, so I was thinking then is you can't have invoices to related parties. So so it's about arm's length transactions with somebody else. You can't have it to one of your related entities and say they haven't paid me and put in a claim, which some people can try. But with in terms of the insured's procedures, they've got to, under the policy, they've got to issue their invoices in a timely fashion. There's deadlines. They've got to do it under the policy after they've supplied their goods and services. They've got to, once they've become outstanding, they've got to have taken particular steps and have notified the insurer about defaults promptly as well. And look, when there's an insolvency situation, like Paul said, that's the easy one. You know, they've done the work, they've issued their invoices on time for payment, and then unfortunately their customer has gone into an insolvency administration. You know, an administrator's been appointed, or a liquidator, or a receiver's been appointed by a bank over the company. That's a straightforward trigger of liability there. And the insured, who's got the benefit of the policy, doesn't have to rush off and deal with a liquidator or anything like that. They go back to the insurer. The insurer will want them to put in a proof of debt with the liquidator and get a confirmation of debt from the liquidator. So, you know, the pressure's off the insured there, where they've got that cover. Otherwise, when they've got an outstanding invoice, there's expectations on the insured under the policy that the insured will take steps to try and recover their debt. They can't have an invoice for the work that they've done outstanding and then do nothing and then put in a claim 6 months later. They've actually got to chase the debt. At a minimum, they should be issuing proceedings and trying to get a default judgment and bringing that to the attention of the insurer. The insurer should be notified when there's a default all along, because the insurer may want to have some take a position in relation to the default by the customer and give some recommendations to the insured as to how they want them to deal with it, or even the insured get involved itself with that particular debtor.
So, okay, so you've done all those steps, and the insurer has paid out on the actually not, the insurer hasn't paid out. The question is going to be, someone like me as an insolvency practitioner comes along, and all of a sudden, you know, you've sued the customer's paid, and I've issued, then subsequently falls over, and then I've issued an unfair preference claim against the client. What's actually covered in those sort of circumstances?
Yeah, so that's, you know, Paul was talking about the different types of cover, and it was about the unpaid invoices which are owing by the insured's customers to the insured. What Stephen you're talking about there is where the insured's been paid by the customer, but then sometime down the track, could be a couple of years down the track, a liquidator of the customer is appointed to the customer, and the liquidator says, listen, you got paid in priority to other creditors, we want that money back. And you know, for those who haven't come across those unfair preference claims, what under the Corporations Act, if just for example, I had a company and I'm running into financial trouble, and I owe people money, and I owe Stephen money, and I owe Paul money, and Stephen's putting pressure on me for payment. Paul's not putting so much pressure on for payment, and I decide to pay Stephen back the money Stephen's owed. I don't pay back Paul. Then I go into insolvency administration later on. The insolvency practitioner appointed to my business may say to Stephen, look, it's a bit unfair that you got paid, Paul didn't. That's an unfair preference in favour of Stephen, and that money should come back into the pool. Now, the trade credit insurers actually provide cover in relation to those circumstances as well. So there can be cover for the insured in relation to those demands made by liquidators where they want them to repay money they've received from their customers. So that's a huge benefit for insureds and should be something that should be considered by insureds when thinking about whether or not to take out these policies, because you know, these unfair preference claims usually come in at a bad time, and it's usually 2, sometimes 3 years after you've been paid as well, to pay it back.
So as long as the policy was in place over that particular debtor invoice at the time, if it's clawed back by a liquidator, it'd be covered. Is that right? Is that how it works?
All the insurers are a little bit different on what their rules are there. Yeah, but look, generally, if you've got cover at the time of that invoice was issued, and you've maintained cover for the next up until the demand is made, then you should have cover under the policy.
Yeah, no problems. So then let's say the insurer pays out. What actually happens then? You know, what's the insurance or the underwriters? You know, what's their role from there? You know, what's their rights? You know, how does that work?
Yeah. So after the insured has had a customer that's gone into liquidation, the insured has not getting paid for its work or goods that it's supplied. The insured puts in a claim with the insurer, and the insurer indemnifies the insured and makes payment of the indemnity amount, and it could be 90% of the debt that's owed. The insurer then can sit in the shoes of the insured, and in terms of, for example, the proof of debt that's been lodged with the liquidator of the customer, the insurer can be dealing with the liquidator and say, listen, if a dividend gets paid out of this liquidation, can you make sure it's paid to us? If there's securities that the insured had over the customer, the insurer can utilize those securities to try and reduce this exposure, because under the terms of the policy and also provisions that are in the Insurance Contracts Act, the insurer, once they've provided indemnity, will have the rights that the insured have to try and reduce the exposure that the insurer has had. So often the insurers will certainly be involved in liquidations. They'll be looking at securities, third-party guarantees, and they'll also expect the insured, even though the insured has been indemnified for most of its debt, to still progress any claims that it has to recover money that might reduce their exposure.
Basically the insurer will sit in the shoes of the insured. Mm-hmm. So that would mean that so personal guarantees, as you said, the insurer could act under those. Any security that might have been provided. So it gives basically the same rights as what the insured actually had. Is that correct?
Yeah, and they work together. Like it's the insurer will be doing these things, the complete knowledge of the insured, and be involved with the insured working together on those. And this happens pre-claim as well. So you can have a situation where the insured has notified the insurer, look, we've got these invoices, they're outstanding. We're hearing rumblings about this particular customer of ours, and the insurer, knowing that it's potentially got a exposure in relation to that customer, might say, right, let's get together and let's see what we can do in talking to this customer about reducing exposure and working with the customer to try and reduce everybody's exposure. And there's provisions under the policies which the insured is obligated to assist the insurer and take reasonable steps to reduce the debt or try and reduce exposure of the insurer.
So during the, let's say you haven't got an insolvency event, you've got this policy in place, and let's say you might have the client might have a customer who comes and says, well, look, rather than having my $100,000 credit limit, I now want you to increase my credit limit to $200,000 or $300,000. Does the insurer have much of a role to play in sort of say that decision, or whether you increase your insurance level to take that customer on? How's that work?
Paul, do you want to answer that one?
Yeah, I'll jump in there. Throughout the policy, every customer has the ability to introduce new debtors and also increase their limits on existing customers or introduce new ones. A policy, it's not your standard insurance policy which you do renew once a year and you put in your desk. It very much works as a risk management tool throughout the year and works alongside of the business. So business takes on a new contract. The process is put it through the insurer, get the due diligence done, and have the limits set. The limits increase further, or they need a higher limit. We go to the insurer, we look to have it increased. We see that every day. Our limit activity, is annually, our customers would process, in the tens of thousands of limit applications. So it is very common that it moves all the time, and we're seeing it even not as much now. It's tapering off, but especially in the first half of this year with inflation and the cost of everything being so much more, the amount of the expectation on all the insurers to increase their facilities was significant. So yeah.
So it's probably one very last question, maybe for you, Daniel. So let's say there's a insolvency practitioner has done a great job, is paying a dividend out to creditors. So the insurer would be a creditor. How does it work in terms of, let's say there's a bit that's not insured and a bit that is? How does that work? Does the insurer take the lead in those cases and deal with the insolvency practitioner, or does the insured deal with them? How does that sort of work?
Yeah, either party can deal with the liquidator there in the name of the insured, and the policy will provide how any recovery post claim is shared between insurer and insured. So, and look, they're all written a little bit differently, but you'd assume if the insurer had paid has paid out on 90% of the claim, and the insured is left with a 10% exposure, and there's $100 recovery, that $90 will go to the insurer out of that. But you'd have to look at the wording of the policy, but it's generally shared between insurer and insured, in accordance with their proportion of liability.
Yeah, and that's where a good broker like yourself, Paul, will assist in trying to get the best policy for the right client.
Good segue there, Stephen. Good segue, buddy. There are a number of nuances around that piece, and also in regards to unfair preferences. Daniel touched on it, where all the insurers provide cover for it, but there are varying nuances that every customer needs to be aware of. So that's right.
Well, look, thanks, gents. We're getting close to time. I'll open it up to the audience as to whether there's any questions. Pop it through the chat function. We'll have a quick look at them if there is anything. Can't see anything. Okay, well, if there's no questions, obviously we answered everything really well, guys, today. Daniel and Paul, thank you very much for giving up your time today to share your knowledge in this area, which I think will become actually quite a busy area. As you say, there's a lot of uncertainty going around at the moment, and if you can use something to minimise your risk, then it's probably really good. So again, thank you very much for taking your time. Thank you everybody for coming. Actually, there's a question that's just come. Here we go. Sorry, just about finishing, but there is a question from Dean, and that is, if you have a lot of small debtors, is this something that can be insured, or do all the debtors need to be vetted by the insurer? Paul, I might give that to you.
That's a really good question. It's a really good question. So, the size really does vary. So, I'll answer you. If not every debtor needs to be vetted. So, on most policies, there's what we call a discretionary limit. And that will vary depending on the size of the policy and the size of the exposures. So once there's a discretionary limit set, there's certain conditions that the client would need to undertake to establish that limit, but those limits can be assessed internally by the client based on the parameters set on the policy. So no, the answer is no, not every debtor needs to be vetted. There is an element of discretion that's supplied on the policy to give the client flexibility.
Thank you.
Yeah.
All right. Well, we're spot on time. Again, guys, thanks very much for giving up your time today, sharing your knowledge. Thank you for everybody for taking the time out of their day to join us with another Red and Black webinar. And look forward to having you join us in about 3 weeks' time for cryptocurrency, for cyber is the next topic that we've got. So thanks once again, guys, and we'll call it a day. Cheers.
Beautiful.
Yeah, bye.
Thanks.